Hi everyone, this is Ted Bauman with Clint Lee here for your Money Matters Monday video. Now today we're celebrating or getting close to celebrating the 11th anniversary of an epic bull run in the stock markets. I think March 9th is the day that it'll be 11 years since the market turned decisively and began to move upward, and it really hasn't looked back ever since. Been a couple of downturns, but very minor in retrospect, and we have more or less caught up. And we continue to be rising. Problem is that some companies that were reasonably priced on a per share basis, that were affordable to the average investor 10 years ago, are no longer affordable, not because they're excessively valued, but because their prices per share are just really high. Amazon, Google, for example, over $1,000 a share. There are 14 companies in the S&P 500 that traded over $500 a share. So today we thought we'd talk about what you as an investor can do if you want to trade those companies, even if you don't have a huge portfolio, which is important because everybody wants to diversify their portfolio, and you want to own companies that are growing well, like these companies, but you don't want to have to pay everything that you have in your portfolio just to buy one or two shares of some monster company. Clint, how did we get here, and what do companies do in response when their share price rises like this?
Yeah, thanks, Ted. So frequently when you see share prices get up to the levels you mentioned, $1,000 plus, maybe not even reaching quite that high, a lot of times what a company will do is employ a stock split. A stock split just simply increases the number of shares outstanding, and because of that, the price of the stock drops. So a frequent ratio you might hear about is a 2-for-1 stock split. That means if you're in a particular stock and you own one share, you're going to get 2 shares back for every share you own, but the impact of that on the stock price will be to cut the price in half. Now, that doesn't fundamentally do anything to change the value of your holdings. You have twice as many shares at half the price. So you're not any richer or poorer, all else being equal after that. It's just a method that companies can use to bring their share prices down. And one example of this, at least relatively recently, has been Apple. Apple back in 2014 did a 7-for-1 stock split. So every 1 share of Apple you owned, you got 7 back in return. And that had the impact to bring the stock price down from, it was around $650 at the time to back underneath $100 a share. If they had not done that, they would be in that north of $1,000 club you just talked about. Their stock price today would be somewhere around $2,200 a share instead of $315 a share as it is today.
Wow. So basically it's an accounting move, right? I mean, you're basically just taking the existing shares and you're saying, well, instead of 1 share for $1,000, maybe let's make it 10 shares, each for $100. And so the people who already have that 1 share now have 10, but they haven't lost anything. But it seems to me, I mean, logically, wouldn't that expand the market for a company that does this? I mean, if they lower their price, they can expect more people to be able to buy their shares. Wouldn't that potentially bump their share price up a little bit when they do a split?
Yeah, that's correct. So that's the main motive to do a stock split and to bring the share price down, is just to make the stock more marketable to a broader investor base. Smaller investors, if one share costs $2,000, that could be a sizable chunk of someone's portfolio. So by bringing the share price down, you're able to market it to a larger pool of investors. That should improve the liquidity of the stock as well. For those reasons, it's usually taken as a good thing for when a company does decide to split the stock.
Now, let's just maybe talk a minute about something else that people have probably heard. In the news recently, we heard about Tesla issuing new shares. And traditionally, when people issue new shares, when a company issues new shares, it means there's more of them out there for the same market capitalization, which means normally the share price would fall. We're not talking about the same thing, right? This is a different animal. Is that correct?
That's correct, yeah. So when a company does decide to do a stock split, there's no net new issuance of shares. This isn't a fundraising effort on behalf of the company. This isn't doing a secondary to raise funds. This isn't a private investor that owns a large chunk of shares wanting to cash their chips in, so to speak. There's no resulting dilution to the existing shareholders whenever a stock split is used.
Right. Well, let me ask you this. I mean, if a share gets to the point where it's worth upwards of $1,000 per share. Does that mean that the company itself is overvalued, or are we talking about something different?
Something completely different. A high share price does not necessarily equate to a high valuation. Although I think a lot of investors these days would link the two, especially with a company like Amazon that trades at a very high price earnings ratio, is a very high price stock. But a high price stock doesn't necessarily mean an excessive valuation. So one of the highest price stocks in the S&P right now, it's actually a lesser known name. It's a company called NVR. They're a home builder, and they trade at right around $4,000 a share. But their price to earnings ratio is somewhere around 17 and a half times. That's actually less than the S&P 500.
Now, is there a reason why a company would like to or would choose to let their share price drift without splitting it? I mean, is there any rationality behind that?
There's not necessarily a rationale. It's just that the allure of splitting your stock isn't what it once was. So the advent of passive investing and ETFs, they don't need a low share price to be able to step in and purchase a stock. Another reason in the past it was attractive for a high price company to split the stock was for index inclusion, particularly the Dow Jones Industrial Average. Because that is something called a price-weighted index, the higher the share price of a company in the Dow has a larger impact on the index movement. So the people who put that index together are wary of including a stock that has too high of a stock price. So splitting a stock was one way of helping you get inclusion in something like a price-weighted index. But the Dow is not as important as it once was. A lot of people are paying attention to broader indexes, something like the S&P 500 nowadays.
Right. So let's move from the interesting to the deadly practical. What does this mean for our viewers? I mean, what can somebody do who wants to buy a piece of a company that is worth that much? I mean, what are their options? We've seen an explosion of no-fee trading. We've seen lots and lots of new platforms like Robinhood emerge, and people want to buy these stocks. What are their options if they see a stock with a ticker price of $2,000 a share? Can they buy it?
Yeah, I'll say it's definitely a great time to be a retail investor. You mentioned the zero commissions. I mean, that's been grabbing the headlines. There's a lot of follow the leader going on in terms of cutting commissions out. But one other aspect, one other new feature that's being rolled out that you don't see a lot or hear about a lot is something called fractional shares. Fractional shares, exactly as the name implies, allows you to buy a fraction of one share. So you can all of a sudden start to think about dollar-based investing as opposed to share-based investing. And just to use Amazon as an example, if I were forced to have to buy Amazon in whole shares, well, one share is going to cost me right around $2,200. But in a fractional-based investing system where your broker allows you to do fractional shares, if I wanted to just buy $100 worth of Amazon, that would come out to right around 5/100ths of a share, or 0.05 shares. You can do that now. There's a lot of brokers that are enabling that, so you can go in with less than the cost, less than the price of a full share, and make that purchase.
Can you give us some examples of common brokers who are doing this? I'm sure it's not exhaustive, but some of the big ones?
Yes, there's actually a couple larger brokers that have recently flipped on this feature. Fidelity, probably the best known. They are now allowing fractional dollar-based investing. Interactive Brokers does it as well. There's a couple newer platforms. I think you mentioned Robinhood. They allow fractional shares, as does Square via its Cash App. But I think, as this has largely been a follow leader move, especially on commissions, I think it's only a matter of time before you start to see the other larger brokers out there, the Schwabs or TD Ameritrades of the world, start to follow suit in this as well.
Yeah, we certainly have seen that when one big company makes a move like this, everybody does. And on that score, I'm kind of interested to see what happens now that JP Morgan has now decided to buy its own brokerage. We'll see what that does. But you mentioned earlier ETFs, and we know that ETFs and passive investing, index investing has become more and more popular over the last decade. Is that also a route to maybe get around an unacceptably high share price?
Yeah, that's also another avenue. It might not be as attractive as going the fractional share route, but you could go out and find an ETF that has a large allocation to one of these high price stocks. We'll use Amazon as another example. With Amazon, there is a consumer discretionary ETF, the SPDR, it's ticker XLY. That ETF has about a 26% allocation to Amazon. So you're absolutely getting large exposure to Amazon via that ETF. The drawback is that ETF is going to hold a lot of other things as well. So it's not a pure exposure, but it certainly is a large portion of that ETF. But there's one nuance to be aware of when taking that approach. The reason why Amazon makes up such a large weighting of that ETF is because of its market size, not necessarily because of its share price, but because of its market cap. So it's a $2,200 stock, but its market cap is just over $1 trillion. And a lot of these ETFs will employ this market cap weighting scheme to assign allocations. Compare that to something like NVR that we mentioned earlier. Even though NVR has a share price of $4,000, nearly twice that of Amazon, its market cap's only $15 billion. Now, when I say $15 billion, I'm putting that $15 billion in the context of Amazon's $1 trillion.
So basically, a company like NVR is not necessarily going to make it into every passive index fund simply because it's not a big company, it just has a big per share price. So that's a very good point to make. Well, we've been here talking about what to do in today's circumstance where some of the big players, some of the biggest names in investing in the last 10 years have got to excessively high per share prices. Doesn't mean they're overvalued, just means that to buy one share takes a lot of your portfolio. We've offered a couple solutions. Thanks, Clint, for suggesting those things. Remember, you have really basically two options. You can go to a broker that allows you to buy just a fraction of a share, or you can invest in an ETF that owns a chunk of the company that you want to acquire. So those are your solutions. But remember, things change quickly in the investment world, especially in the brokerage space. It's been a lot of changes in the last 12 months, and we expect to see more. So who knows what's coming next? Anyway, this is Ted Bauman here with Clint Lee. We will talk to you again next Monday with Your Money Matters. Take care.